She's amazing. And she is going to teach us today how we can prepare to sell our businesses. I don't know how many of you guys exiting your businesses, but I don't know what happened there. That was really weird. Whoa, that was strange.
I went home.
It had me join twice. That was really strange. But anyway, I don't know how many of you guys have thought about exiting your businesses, but I'm sure eventually you do want to exit. And so what have I've learned from Yael over the years here is that it's really important to know how your business might be valued so that you can prepare ahead of time. And it's important to know what things count towards the sale of your business, what things don't count, so that you're able to really think ahead of the game now, begin with the end in mind. And Yael is amazing. Her company Fortunet has been able to get really great values for people's businesses. So yeah, we're so excited to have you, Yael, and thank you so much for being here. And why don't you tell everybody a little bit more about you?
Sure. My name is Yael Cabilly. I'm one of the co-founders of Fortunet. It's an investment banking firm that helps sellers selling the business. We focus mostly on medium and large Amazon businesses, mostly FBA private labels, but also softwares, agencies, whoever's in our business and wants to sell. We're trying to, I'm going to go through a presentation where I'll try to explain how to prepare for a sale. Knowing what we know today, I can say as a start that we're in a very good period. The industry is now, everybody knows it's hot and it's booming, and and there are many new comers in our industry. So it's a good time, and by the way, it's probably going to remain a good time in the next year or two. So don't panic and throw your business now to the first who's asking. Our philosophy really is it's a lifetime event, and if you do it, you want to do it right. You want to maximize the value. You want to get as much as you can out of this exit. So most of our clients, by the way, are those who want to maximize it and not particularly a very quick sale for whatever multiple. We're working mostly with those who are looking at the price. And by the way, the buyers as well. We work mostly with buyers who are not looking for cheap businesses. So should I start?
Yeah, I will show your presentation on the screen here, and I'm going to hide me.
Okay, but now I don't hear you. Do you hear me?
Yes, I still hear you.
All right. Okay.
Okay. So yeah, and we definitely see your screen, and we're on the slide of Fortunet, part of the Amazon sellers community.
Okay, cool.
All right.
Okay. All right. So I explained a bit about us, the three founders of the company. There's Michal. She's the CEO of the company. She brings the M&A knowledge. She's been dealing with mergers and acquisitions in the last 10 years. She's an attorney for 25 years. I'm an attorney as well. In addition to Fortunet, I also own a law firm that focuses on Amazon. We've been working with sellers over the last 5 years, probably around 5,000 sellers. So we've been dealing with Amazon issues and sellers for many years. And the third partner is an ex-Amazon seller. He exited and sold his business through us and joined us. He's also a CPA originally. So the three of us founded the company together. We're 17, and the rest of the team, these are analysts and financial, and lawyers and everything you need to kind of make this deal happen. So I want to start with a few questions that we get a lot, and then we'll move to the details. One of the questions I'm often asked is, should I have a U.S. company? Is it okay that I have a Chinese company? Is it okay that I have a Ukrainian company? So the answer is that most buyers are selling your assets. So they're buying your trademark, they're buying your account, they're buying the listings and the copyrights, everything you have, but they're not buying your company. So basically, it doesn't really matter what you have. If it's a Chinese company or a French company, they will buy your assets. That's true for most of the sales. For the larger ones, for transactions that we do, over 20 or over $15 million, sometimes we're talking about the sale of the company. If there are transactions where the buyers is interested in the team, so sometimes you would sell the company. But if we're talking about medium, small transactions, and the average transactions, again, you sell the assets. So don't worry about the type of company. The second question that we get a lot is, will I have to stay in the business for a long time after the sale? So here too, in most of the transactions, the seller doesn't have to stay for long. Usually there's the training, and he or she is required to stay for about 3 months. In reality, it's usually about 1 month of training, and that's it. If we're talking about a buyer that knows what they're doing on Amazon. Now, if we're talking about the larger transactions, in some of the larger transactions that we have, again, those above $20 million, for those, when there's a team of 10 people, 15 people, when there's an entire operation, there the seller is required to stay more. And sometimes the seller wants to stay to make sure that he gets the earnout. We're going to talk about the structures of the deal. So medium and small, you won't have to stay, not likely, but for larger businesses, that's a possibility. And again, not forever. I want to talk about the types of buyers. So most of us have heard about the aggregators, right? The Thrasios, and there's Boosted who spoke here, and Perch, and a lot of companies that everybody knows. They've raised about $3 billion in equity and lending. I mean, we know them, about 60 companies. Usually the good thing about them is that the deal is very quick. They usually close within 45 days. And they're very professional. They know what they're doing. What you want to do, I guess the mistake usually is where a seller gets an approach by one buyer and doesn't check the market. So we're going to talk about it later, but you want to make sure you saw the entire market, because if you get one offer or two offers for those who approach you directly, you may be missing out and leaving a lot of money on the table. So we're going to talk about the auction process later, but if you're going for the aggregators, make sure you tap the entire market and all of them. Make sure also that you understand the structure. It can be misleading. For example, I had a client who told me, I got an offer from one of the aggregators for 6x. So I said, wow, this is great. And then he said, so it's 2x upfront, a multiple of 2 on the profit upfront, and then a multiple of 2 in 2 years, and then et cetera, et cetera. I mean, that's, you just sold your business for 2x. So you have to make sure that you know what you're doing when it comes to the structure and understand what they're suggesting. You also want to make sure that it's balanced, because the aggregators are doing those deals again and again. They usually have a team of a bunch of lawyers. They have a team of M&A consultants, investment bankers. So you want to make sure that you know what you're doing, and that that there's a balance between you and the buyer. Another type of buyer, I'm running fast because there's a lot to say today, but feel free to stop me. Another type of buyer is the strategic buyer. So the strategic one is very relevant when you're selling in a specific niche. For example, I don't know, you're selling toys for girls. So we may approach a buyer that is in this industry and not necessarily on e-commerce. Usually they want to take full control of the business because they want to own it entirely. And we usually see higher multiples. It's relevant for the larger businesses. Usually you want to go through our process if it's a small business, but for big businesses, and if you have time, it may be worth it. Then there are the private equity firms and family offices. These are kind of newcomers in our industry. We're seeing them more and more. A lot of the deals go there lately, especially the medium and large ones. In the past, it was a bit difficult because they were too large and they weren't really interested in Amazon businesses. But now those Amazon businesses are getting larger. And there are some of the private equities are kind of boutique private equities, and they have been looking at e-commerce for a while. So this becomes interesting. Again, the multiples are higher; they're willing to pay more, but the deal can take more time than for example the aggregators. Sometimes the deal is interesting. You're selling part of it now, and then the rest, let's say 80% now, and then you remain with 20% and you stay in the business, and then you operate it, and then you get kind of the second bite of the apple, which can sometimes be bigger than the first one because you stayed and it's larger now. So you de-risk you de-risk first, and then you enjoy the profits later. The last kind of buyer is an Amazon seller. We're seeing them more and more. Those who get to 10 million sometimes want to buy another $1 million brand. So it's becoming. It's especially true for the smaller accounts. Sellers are usually not buying the larger accounts. What they do is sometimes they buy them to improve, kind of flip them, to improve them and to sell them. We're seeing some of them are those who did an exit, so they're buying and then flipping another business. Sometimes they're not so experienced in the process of M&A, so they and you will need a consultant to help in those kind of transactions, as opposed to the aggregators or private equities who are doing that all the time. Let's talk about the value of the business. Okay, so we've discussed how the transaction looks like. It's as I said earlier, it's a sale of your assets. We talked about the kind of buyers. Let's talk about your what you're gonna get, the value of your business. So in this industry, we're talking about SDE. SDE is the profit. In other industries, we usually talk in other industries about EBITDA. In this case, it's a kind of EBITDA, but with add backs. So I'll explain in a second how you calculate the SDE. But the SDE is the profit that you have. Okay, so you take the last 12 months, so the profit in the last 12 months, and then you apply a multiple to that. Okay, so the multiples that we see can be anywhere between 3 to 7x on the profit. Sometimes a little less, 2.5, let's say. It can go higher than 7x. We've done recently one of I think it was 8.5 on the profit. But these are the common one that we see. The most common one are 3 to 6x, I would say. So we're taking your profit, we apply a multiple, and to that we add the inventory. Okay, so the inventory is on top of that. There's an example on the bottom. If you have 600K of profit, you apply a multiple of 5.5. So the transaction is 3.3. And then the inventory on top of that.
Yeah, we have a question.
Yes.
First, I want to say hi to everybody who's on the live stream. Tim is watching along his drive today on YouTube. And Haroon wants to know, please discuss the process of how ownership is transferred. And are you going to talk about that later, or did you want to touch on that now?
So I'll explain. So we're talking about transfer of assets. So for the trademark, there's an assignment that we file with the USPTO. Very simple, takes about a week. And then there's the Amazon account. For that, what we do is we ask for Amazon's permission. The buyer, actually the current seller asks for permission. And then Amazon gives permission to change the ownership in the account. And then you go ahead from the computer of the seller, you change the ownership to the buyer. You change the legal entity, the bank account, the credit card, phone number, email, everything. And you have to do it step by step. I know a lot of buyers do it all at the same time. We like to advise buyers to do it step by step so that Amazon doesn't get panicked. But the most important part is to get Amazon's permission. Without the permission, it's not allowed to change the ownership. So that's the way it's been going, and I haven't seen any problems. We've seen over 100 of those migration, we call it, and I've never seen an issue where it was entirely suspended. I saw, I think, one issue where they raised something about related account, but the seller actually had a related account and it was solved. So that's the process. Another option is to transfer the listings of the seller to the account of the buyer. So the buyer kind of adds the product from his account, like a hijacker, basically. And then, so the seller sells out his inventory, and when the seller finished the inventory, the buyer continues from the buyer's account.
Got it. So they just kind of like relist it and like relist it under the buyer's inventory if it can't be transferred, and the buyer just continues selling it from there.
Yeah, exactly. That's what we do in Europe, by the way. In Europe, you cannot change the ownership of the account. I mean, you can. It's extremely difficult, and there are a lot of issues there. So that's how we do it in Europe. You do have to transfer the brand registry if you're doing that. So you're
awesome.
You're opening a case, and that's what you do.
And I just wanted to say hello to Monica, and Monica says, "Greetings, Yael."
Hi, Monica.
All right, so I'll let you get back to it. It's really informative thus far. So
yeah. It's a lot of information, and I'm sorry if I speak fast. I know I speak fast, but I want to get to all of it. And feel free to stop me. I love questions, so feel free to stop me. So we were talking about how to calculate. So as we said, so the value of the account is the last 12 months, the profit in the last 12 months times a certain multiple. We'll talk later how to, which multiple you should get, and plus the inventory. So how do you calculate this profit? So SDE, as opposed to EBITDA, what you do is you take your revenue and you retract the cost of goods and shipping. You retract all of Amazon's fees, of course, all the marketing expenses, the PPC, obviously, and any other marketing that you're doing. Some sellers are doing the rebates or other types of marketing. And you retract the software like Helium 10 and other softwares that you're using, or other direct expenses like VAs or any other expense that's directly related to the business and that the buyer will likely have too. What you add back, okay, what you do not include in that profit is the salary of the owner. Okay, you add that back, so it's not an expense that we calculate there. Okay, so the salary of the owner and any one-time expense like a trademark, that's not something that the buyer will pay because it has already been done. The owner's salary, same, is not going to have the owner's salary. The rent, for example, I see a lot of sellers putting the rent and calculating that. It's not how it's calculated. So we add everything back to the profit. Okay, so very important. I see, at the end, the value is based on the profit that you calculated. And remember that every dollar can be $5, can be $6. So if you include, and I'm going to get to that later, but if you include an expense that you shouldn't have of, let's say, 100K of your salary, you just lost 500K. Okay, very, very important to know how to prepare this P&L. So that's how we calculate the profit, and that's the way you calculate the value of your account. Now, how do you know what multiples you should get? So there are several factors, based on our experience, that buyers are looking at. And as you said at the beginning, it helps to know what buyers are looking for, especially if you're creating a new brand now. And if you have the exit in your head at the end of the process, then you should definitely know what they want. So the first thing they're looking at, and I'm going to do it fast, is this account growing? Is it growing year over year? And that's very important, because growing businesses get amazing multiples, flat businesses get okay multiples, and declining businesses sometimes get bad multiples. And it comes when we're going to talk about when to sell. So on the one hand, you want to sell when the account is growing, right? I mean, you want the buyer to be happy, you want the buyer to give you a good multiple, but when it's growing, you're saying, wait, if I wait a month or I wait more, I'll get more. So you always think about when to sell, because when you wait, the more you wait, the more you'll get. But then there's a place where sometimes they start, flattening. So just remember that you can't wait so long. You can't wait until it goes down. Okay. Because it will show that will affect the multiple, that will affect the transaction. So that's about the growth of the account. They're looking at the age of the account, how long you've been operating. If it's trendy or evergreen, I can say that selling a trendy product is very difficult because buyers, they buy something and they're thinking about how much time it will get to cover the cost. And if the product won't be there in a year, you won't get a multiple of 5 on that. So that's about the type of the product. So most of the buyers are talking about an evergreen product. They're looking at reviews, obviously. Very difficult to sell an account or a listing with 3.5 in reviews, or 3 or 4. They obviously want more than 4, and hopefully 4.5 or 5. They're looking at competition. If you have patents, that adds to the valuation. So when we start the process early with clients, I always look, can we patent something? Is there something we can protect to kind of take up the valuation, the value of this account? They're looking at the number of SKUs, and that's very interesting because for some buyers, a lot of SKUs is good because they're buying just one account and they don't want to put, all the eggs in the same basket. So they want a diversity. But for others that are buying tons of accounts, like, the aggregators, they don't want complicated, complex accounts where you need a lot of people to manage it, because 500 SKUs, that takes time, or 2,000 SKUs, that takes time. So the number of SKUs kind of depends on the type of buyers. But generally speaking, if you have less, that's generally good. So we've had cases where we started the process, and they got very few offers. And then we realized that if we with the clients, if we take down the number of SKUs, even if the profit will be a little less, the multiple can go up. And that's exactly what we did. We cut the number of SKUs by half, and then they got amazing offers. So remember that with the number of SKUs, when you choose the product, when you choose the category, if you're already there, you're already there. There's a buyer for everybody. It's just simpler with less SKUs, I guess. Other factors, they're looking, of course, if you've been suspended, how long do you need to manage this account? That goes with the number of SKUs, by the way. The accounts where we saw the best valuations were businesses where the seller just works 3 hours a week on this and doesn't invest much, and there's like 1 or 2 SKUs, so it kind of goes together. Is it active in more than one market? I mean, is it only in the US or other markets? And that, by the way, can go both ways. So a lot of sellers are saying, wait, I'm only in the US. What will I do? And, it will affect my valuation. On the contrary, the buyers are looking for easy expansion. So if you're only in the US, that's an easy expansion, just taking it to Europe or to Canada or to other markets. So if you're there, great. If you can get there, amazing, because your profit will go up. But if you don't worry about it. The buyer will do it, and it's a plus. So that's about that. And then there are other factors around suppliers. How many do you have? Is it all around one supplier, or do you have a few options? They're thinking about the risk. Can you sell it in retail? You probably can say much more about that. And then but that, by the way, is relevant for some of the buyers. Some of them are not looking to go to retail, and for some who come from that world, it's very much relevant. And then they're looking at the ROI and profitability. If you have any questions, stop me there.
Well, I just love what you said about, you don't need 800 SKUs. You don't need, your business is going to be worth more if you focus on just a few really great products that are cornering the market, good branding, good differentiation, and are making good sales, right? Versus if you have 500 commodity products that anyone can source, and it's not as valuable to a buyer, because then they can take those few products that really represent a brand and expand them not only into multiple marketplaces, but into retail if they would like. It looks like a juicier offer to a buyer, instead of 500 different SKUs that they now have to organize and try and figure out, how to make it work. So I love that, because that's really what we focus on in the Concept to Launch program at Amazing at Home. We focus on building brands with a few really, really great products, getting them selling, controlling our price, because if you have a really great product that is differentiated and built just for the customer, you can control the price. You don't have to, do all these kind of crazy giveaways and stuff. So that is a question that I have for you, is if someone is doing the model where they're basically ranking a product and they ranked it basically on kind of giveaways and reviews, is that easy for a buyer to kind of see through that? And do they know it's going to be very difficult for them to kind of keep that product in the top position? Or how do they look at that?
So sometimes, once it's done, and the reviews are there. So, in many cases, sellers are doing rebates, and they have several techniques for launching the products. And sometimes it's not completely white hat, and buyers have heard about everything. They know about everything. They will know about what you did because they're doing a due diligence, and you'll go through everything. So when it's extreme black hat, and something that puts in danger the all your reviews, that's an issue. But if these are the regular techniques, and this has been done like 2 years ago or a year ago, okay, and since then there are sales and everything goes well, the buyers are not that concerned about it.
Right. It's
So
just if you basically got 400 reviews in an hour,
yeah,
and
that can be
you're
a problem.
yeah, exactly. But if you genuinely used regular techniques that most people use in the beginning when they're launching a product, you got nothing to worry about. It's just if you're really fighting to stay in the top position and 2 years later you're still fighting, well, in that case, your ROI and your profitability isn't going to be great anyway. So I think that that no matter what, it will devalue your business. So it's just something to think about when people are choosing their products. They really need to think about, okay, is this a product that a buyer is going to be interested in buying if I can really corner the market? Or is it something that is so easy for anyone to source, and there's going to be a lot of competition and profitability is going to be hard, right?
Yeah.
Cool.
It's,
Makes
I mean,
sense.
the buyer is looking at it just like you at the end. I mean, they're afraid to put $5 million or $10 million on something that's shady, but they will if it's something that's been stable and and you launch like everybody else. I think that today Amazon is stricter when it comes to rebates, for example. We've seen a big wave in the last 6 months around review manipulation, and Amazon, it is not easy these days. So if you pass this wave, and if you're okay now and you're not using these techniques anymore, you should be fine.
Got it.
Today, basically, the only way to get reviews in the eyes of Amazon is basically PPC. I mean, the only way to launch is that today. They kind of killed everything in their terms of service. But I don't know many sellers who just don't do anything. So really
Right.
depends on your style and risk tolerance. Buyers have a risk tolerance until a certain point. So that kind of answers the question, I think.
Yeah, I agree. Yep. Your product choice matters, your suppliers matter, all of these different things that you're looking into matters. So it's awesome. All
Yeah,
right.
yeah.
Keep it coming.
All right. So I started talking about the P&L and the importance of the P&L. And we at Fortunet, we always say that the P&L is the first step of the negotiation. At the end, this SD that we were referring to, your profit on which there will be a multiple, is the net. Okay, the net profit, the net income before tax, but then you with the add backs. Okay, and what are these add backs? What can we add back so that the SD will be higher? So we spoke earlier about the owner's salary, right? I mean, if you include it, you lose a lot of money. And then there are personal expenses, like the rent, or you just bought a car. That's something that you will add back to your profit. And then there's intellectual property like trademarks and patents and copyrights. These are things that you do once, the buyer won't have them. Okay, so we're going to argue that that's not part of the expenses there. And then there are website designs, all the one-time things that are not relevant to the buyer should not be an expense that is counted in your P&L. Okay, it should be added back. Masterminds, events, reduced cost of goods. So sometimes, for example, our clients have let's say their supplier charge them $2, and then in the middle of the year they negotiated and it's 1.5. Okay, for the buyer, the next year they will pay 1.5. Okay, so sometimes we fight to have this 1.5 calculated for the entire year instead of like half a year 2 and then half a year 1.5. Okay. And then there are the reduction in tariffs. Sometimes, you pay a certain percentage and then it goes down in the middle of the year. Same thing here. The buyer won't have that expense. We'll fight for that. So again, every dollar can be $5, $7. We have tons of examples around that. People using here's an example. People using air freight. Okay, our client used air freight the entire year, and we calculated that if the client did not use air freight and use sea freight, then the expense would be probably around 100, let's say 100K per year. Okay. Now, if you have a multiple of, let's say 5 on that, it's 500K that you're negotiating here. It's a lot of money. So we're always thinking about this P&L. We're always thinking about adjustments. What can we adjust? How can we negotiate? If you were out of stock for three weeks, because you didn't have the fund, that's not something that will happen to your buyer. So let's adjust that. Let's try. Let's negotiate that. If you had a suspension, let's try. So there are a lot of things to think about when you're creating this P&L. And sometimes as a lawyer, I help sellers with sometimes I always also help on the legal side, and I get the case when the deal is done, and I see that the seller has left 700K on the table. So I think that think twice before you just let the buyer prepare the P&L for you, and it's very important to negotiate every part of it. And if you're not sure how to do it, then obviously take a consultant that will help you with that, because they've been doing that for a long time, and they know exactly where to negotiate. So that's about the P&L, which is the first step of the negotiation. Now, another part that's very important, in our opinion at Fortunet, is the auction. So when you negotiate with one person, or even 2 buyers, or even 3 buyers, you can get to a certain point, right, between the 3. But when you show your business to all the markets, to hundreds of buyers, the aggregators, the private equities, the VCs, the sellers, all the relevant buyers for your specific business, what you're going to get is a lot of bids. And then usually what we see is that all the bids are kind of similar. And then there's 1 or 2 for which the business is worth much more. And you want to get to that buyer, the one that for which the business is worth more. And sometimes the difference is just crazy. We had transactions where the difference was $2 million or $3 million. So it's very important to make sure you speak, everybody sees the business, not just 1, not just 2, so that you get to the maximum price. Now, I'm going to talk about other ways to create value and kind of maximize your deal. Sometimes we're trying to think of creative ways to take up the values, and I'll give a few examples. When you have a growing business, and let's say you're selling in the toys category, okay, at the end of the year, something very interesting will happen. It's Q4. Your sales are going up. The profit is going up, and you're going to finish the year sometimes 2 or 3 times what your profit is now. So what we can do is to kind of form a projection, based on the numbers now and what we foresee for the end of the year, and then sell your business not based on the profit now, but based on that projection. Of course, it requires a very detailed one and very convincing one, and sometimes it requires you to stay in the business for for sometimes not, sometimes there's an adjustment if it doesn't happen. But if you do it right in some of the businesses, especially the larger one, that is possible. Especially lately with the industry right now. So that's one type of way to increase the value. Another way is to reduce the number of SKUs, as we said earlier. You may have a lot of SKUs, but if you and the SD is higher, but less buyers are interested in those. So what we do sometimes is we take down the number of SKUs. We lose a little from the SD, but then the multiples go up, and at the end the value is higher. That's another way of thinking creatively about the value of the business. And another way is to integrate brands. We've done that several times, and it was interesting. There was an amazing feedback from the buyers of the industry. What we did is we took several businesses together from the same category, and we sold them together. And since we know that larger businesses get higher multiples, buyers loved it. The businesses, they sometimes they even compete with each other. So you as a buyer get more real estate on the first page, you can say. And so you integrate it. It attracts more buyers. And as I said, the multiples is higher, but you need to find the right partners. It's not always easy, to get two people together, two owners of Amazon businesses together. So what we do is we set really clear rules, and we can already say which sellers are fit for that and which are not, and that's fine. They can, we can sell the business separately. So that's something we've been doing in the last year, and has a very good feedback and takes up the multiple. Instead of your business, you and another together, higher SDE, higher multiple. So let's talk about the deal structure for a second. We have, that cash is king, of course. I mean, you want to have as much cash as you can. But sometimes, especially larger businesses, they're willing to stay in the business or to kind of bet on the success of their business in the future and get some upside from what's going to happen in their business. So in most of the cases, what buyers suggest is a certain percentage of cash, let's say 80% cash, for example, and then the rest can be divided. Can be, for example, I'll give a few examples. It can be deferred payments, but guaranteed. For example, 10% of the payments will be paid in a year from now, and with interest. Okay, let's say a year from now with interest. Sometimes it's every quarter you get some of the payments, and sometimes this component will be an earnout, which is subject to stabilization, meaning that if you're let's say the buyer will say, I'll give you 10 additional % if the business doesn't go down, doesn't start falling, or doesn't fall more than 10% from what it is now. So that they kind of that's something to protect the risk of the buyer, of course. So that's based on stabilization, and sometimes there's a profit share. So we sometimes see, for example, you'll get a multiple of 4.5 now, and then you'll get 50% of any profit above the current SDE. So let's say your SDE, your current profit in the last 12 months was 1 million. If next year it's 2 million, then 500K go to the buyer and 500K go to the seller. Okay. So that's something also that we see, like a certain percentage, I say 4.5, 5x now, plus this kind of profit share, the split of the growth. So there are several deal structures, and as I said, it's very important to understand what they're offering you and how to protect yourself. How to make sure that you actually receive the money. What happens if you have this guaranteed payment in a year? What happens if the buyer doesn't pay it? So there are legal ways to kind of protect you so that it will happen. Let's say if it doesn't happen, the trademark goes back to you or something like that. So make sure you're protected and that you understand the structure and that it's the best structure for you. For us, I think that the structure is probably one of the best part of it's the fun part of the transaction, thinking how to build it in the best way for our clients. The client has 2 products that have just been launched, and we want to have profit from those because they weren't counted in the valuation. So we're thinking about how to structure it so that we will include those. So that's in a nutshell about the deal structure. So maximizing the value. We spoke earlier about a few things that can maximize the value. The smart P&L. We call it smart P&L, a P&L that, with all the add backs and think about adjustments. We also tell the story of your business. We present the business in a business presentation that shows all the advantages of the business. That also adds value. The auction that we spoke earlier obviously adds value to the exit and takes you to the highest multiples, basically. And then there's what you do now before you sell the business. So while you're in the process or in the year before you exit, a lot of clients ask us, what should I do? Should I start selling in retail? Should I start a Shopify account? I'm going to sell it in 5 months. Should I start Shopify? Should I start this and that? I always say, don't just change your entire model just to get a higher multiple. Okay, so you heard that buyers like to have several channels. That's true generally, but if you have 5 months, it's going to be hard for you to dive into the retail or to dive into Shopify if you don't know what you're doing. If you have time, that's something else. But be very focused. If you have a short period of time, just be very focused on what you're doing and do what you do best. So, if you're very good at launching new products and you do that all the time, then do that. If you're good at conquering new markets, getting to Europe, getting to Canada, then do that, or just launching variations. Basically, do what you do best. If you have a short period of time, just be very concentrated on what you do and don't be distracted by other things. At the end, the buyer wants a healthy, growing account. So, if you're going to neglect what you've been doing now and start a new adventure, the account will start going down, and we've seen that, unfortunately. So focus on your account and don't take crazy risk. Filing false complaints against competitors or things like that. Not a good idea when you're selling the business. So just stay out of that. Don't take crazy risks. Just take the regular risk that you've been taking so far. So that's about the maximizing your value. So how should you prepare for the exit? What should you do? So I think that we've spoke about all the things that buyer want and what you do once you're in the process. I think that if you're starting the process in a year, it's a good time to start talking about it. So when we speak with our clients, there are several things that we do together to make sure that they're prepared and they don't lose money. For example, We had a case now where we went with our client to their accountant, to their tax consultant. We spoke about their taxes, and the tax consultant was about to change the entire structure, and they didn't know that the client was going to sell the business, and we kind of stopped a kind of catastrophe there on the tax part. So very important to be in touch with your accountant. We had a case where the seller had a company in this country, and they had a partner in another country, but the company itself, I mean, one lived here, another lived there, and the company was in a third country. So we advised the client to go to one of the top four accounting firms, EY and Ernst & Young and all these PwC and all these companies, and then they built a structure. And eventually they had to change the country. They actually moved for the sale, and they gained probably about $1 million just because of this change. So taxes are very important to start early. You'll need a good lawyer. So most consultants can refer you to good attorneys in the e-com space. It needs to be someone with experience in that space. Make sure that your IP is in order. So that's also one of the first steps we do, is make sure that you're protected for all your products, but also see if we can, if we can squeeze a patent there, or a design patent, or if we can register copyrights to take up the valuation of your business. And then, as I said earlier, make sure you tell the story of your business. You show the buyers all the strengths of your business, and where you are compared to the competition, and that you tap the entire market. And I guess a last slide to finish, and of course feel free to ask me if you have any questions. When's the best time to sell the business? I think that's probably one of the most common questions we get. And we spoke earlier about the growth part and how important it is. So you cannot wait until it stops growing. It's just less attractive. It's still sellable, but less attractive. So you want to sell it when it's growing. And then you should ask yourself a few questions to understand, when's the right time. Like, do you want to grow to a larger team and to scale? So, for example, when you get to sometimes 6 million, sometimes 10 million, you kind of need to scale. You need more people. You can't handle it anymore. We speak with a lot of sellers. Sometimes they sell just because they don't want to deal with a large team. Come in the morning and have 10 people to speak with. They prefer staying at home. So ask yourself where you are, if you're willing to scale. How do you feel with the risks of Amazon? Some sellers, they just, they sell the business because they feel that it's Amazon and you can be suspended. So they're saying, I know how to build a brand. I will sell it. I will cash out, and then I will do it again. And it's actually interesting to see, because the second time it's so much faster. You have the funds, you have the knowledge, so you're doing it just like that in most cases. So we're seeing sellers after 1.5 years getting to what they did in 4 or 5 years. So that's about the risk of Amazon. How do you feel about it? If you're okay with it, so you can continue, or if you don't sleep at night at all, maybe it's a good thing to sell it, to cash out, and then build the next business, the next brand with a different approach. You'll sleep better. So will you start a new business? A few questions that you can ask yourself. What's the projection? Is it growing like crazy? So maybe you should wait a little, or sell based on projection, like we said earlier. Or it's not growing that much. So it doesn't really matter if you wait or you don't.
This is one of the hardest decisions, I think, to make, is, you're torn between how much more can I grow my business on my own, right? And how much do I want to stay in it? I think that's
Yeah.
another question, like you were saying. I mean, something that we're struggling with right now is we've recently started selling in retail, and and we're thinking, okay, in order to really grow in retail, we're going to have to change some things around logistically.
Right.
And that is going to be a lot of work. And it may just lead to more growth that we don't know if we want to manage. So
Right.
that's why we're working with you right now to just understand where we're at, where we could go, and really get a better idea of to make an informed decision. Because there's nothing wrong with putting the feelers out there when you guys are starting to think about selling your business. Like, even if you're a year out, for me, I was a year out. I was like, okay, I'm going to sell my business in 2022. But as I started going into some of these growth factors, I'm like, ooh, man, maybe it wouldn't be so bad to sell it now, So I think it's all about what you want out of it. And if you've built something that is, I think what Boosted said on our seller roundtable the other day was, there is never, it's like having children, right? There's never a perfect time. There's never
Right.
going to be a perfect time to sell your business. There's never going to be a perfect time to, it's never going to be perfect. And what he said was, buyers expect there to be some stuff that needs to be
Right.
worked through. So don't wait until you have everything all buttoned up and tied up and perfect. Would you say that?
Yeah, I agree. I'm thinking about myself. Like, I was with the first kids, I was waiting to be ready for the kid. Like, I was waiting, and this didn't come. So I just decided, okay, let's have kids.
Yep.
And the second time, I knew I don't have to wait because it doesn't come. So I'll just do the second one.
Yep.
But I agree 100%. I think that you do need to think about your growth, and again, if you're growing like crazy, unless you get a value that takes into account your growth, then sometimes you may want to wait a few months.
Right.
But
But
things
that's
are
what's great about working with a company like Fortunet, that can kind of break things down for you. And the story that you told me about somebody that came to you and you were able to help him clean up a few things because his PPC spend was pretty
yeah,
high, but you guys were able to help him clean up a few things and understand where those factors were that might prevent him from getting the most value out of his business. And,
yeah,
that was like the highlight of your year, being able to help him sell his business as a young kid for
yeah,
multiple millions of dollars. So I think that it's really cool if we're thinking about selling our businesses. Number one, all of us can take this information today and put it in our brains and go, all right, we need to be thinking about these things as we're running our businesses, and how easy it's going to be for us to hand it off to someone else, number one. And number two, there's nothing wrong if you're even getting close to where you're even thinking about selling your business. Nothing wrong with reaching out to someone that understands that, so that you can get an understanding of, where am I at and where do I need to be, and what are some factors, some levers that I can pull to have the most impact on my valuation, right?
yeah, 100%. I think that I mean, that's why we always, we started realizing very quickly at Fortune that we need to come in very early, because the first step is the strategy. And I think that a lot of sellers don't know, because they don't know the numbers. They don't understand completely where the profit is, if it's good or not, if something can be improved. So what we do is we start with the P&L. We start with understanding the numbers. And then we decide when's the good time. So the example you gave is, the one where we started with the P&L, and we sold the business actually a year later. But when we did that P&L and we started, we saw that the seller was spending a lot on the PPC, and something didn't make sense there. And we see, we're not geniuses, but we see that something it was wrong there compared to other businesses. So he eventually sat with my partner for like 3 days. They changed the PPC strategy, and the profit went up from 18% to 26%. A year later, he sold that business for over $20 million. And, just calculate how much does 8% mean. So sometimes just by looking at your business, nothing more, just looking at your business, things come out. And as I said earlier with the taxes, sometimes we started with our regular steps, right? The P&L, the taxes, the IP, the compliance, all those things, to kind of prepare, and crazy things happen, like the taxes, where we save $1 million just by that. So I think there's not much to lose by starting early.
Yeah, definitely. Because then if you can identify those things, you can really get after them. I know, I do have a bookkeeper, but my bookkeeper she's not in the business of selling businesses. She's in the business of keeping books for Amazon sellers, right? Which she does a great job at that. But I need to be able to look at my P&L from a perspective of selling it. So that's where companies like Fortunet come in. So speaking of that, before we sign off today, who should come to you? Like, who is the ideal customer for Fortunet, and how do they do that?
So any seller with a revenue usually above $1 million that is considering selling the business in a year, or more, or now, but anywhere in the coming year. The sooner the better. Even a year and a half, start talking now. And the way is just, by email, Facebook, or whatever is easier, through our website. It's fortunet.net. We're very available and always happy to talk, even if it's not relevant now.
Cool. Yes, I completely agree. You guys are very responsive. You're awesome. It's so great for people to have this knowledge. I know me as a consultant, I'm looking forward to working with you, because I want to learn more how I can help my clients prepare their businesses for sale. And now I'm going through this process myself. And so it's so good to learn, what do we need to do and how do we prepare? Because we always want to begin with the end in mind. And so if we are wanting, even if we're not wanting to sell at the end, it's still good to know our numbers and know what makes a profitable, awesome business. So thank you so much, Yael, for your time today and for helping us understand this. And thanks everyone for being here. We appreciate you so much. I know a lot of our listeners are going to be catching the replay, because our guys on this Australia side are just waking up, probably in about an hour here. But yeah, I know everyone's going to really enjoy the replay today. And thank you all for being here. Thanks, Yael. Any final words before we sign off?
Thank you. Thanks for having me. Always a pleasure. And I'll see you soon in person.
Yay!
Very excited about it.
Me too. All right. Bye, everybody.
Bye,
we'll see you soon. Bye.